Global tensions are building again as US Federal Reserve Chief Ben Bernanke told Congress that the future is unusually uncertain. The downbeat comments came as tough new banking laws aimed at protecting consumers were signed into law by President Obama. The outlook and the crucial results of the stress tests of the health of European banks due out tomorrow could have important domestic implications ahead of the Reserve Bank's next interest rate meeting. Phil Lasker reports.
The global market community is looking for light at the end of the tunnel, but they didn't see it from the world's most influential central banker. Prudent planning, but no action.
Even as the Federal Reserve continues prudent planning for the ultimate withdrawal of extraordinary monetary policy accommodation, we also recognize that the economic outlook remains unusually uncertain.
The words unusually uncertain were enough to disturb the fragile confidence and set global markets on edge. Ben Bernanke told Congress he wasn't expecting a double-dip recession, but the recovery would be sluggish, and that means stubbornly high unemployment for this Obama term.
I think the realistic expectation in the US is for a slow and fitful recovery with a lot of pain in the US, but that's probably still the best place the global economy can look to for revival, maybe not in 2010, but by 2011-12.
The Fed chief says he's ready to boost the stimulus if necessary.
The large deficits, as unattractive as they are important for supporting economic activity, and they were important also in restoring financial stability. And so I think they were justified in that respect. And I would be reluctant to withdraw that support too precipitously in the near term. At the same time, to maintain confidence and keep interest rates low, it's very important that we have a strong and credible plan for reducing deficits over the next few years.
President Obama signed into law a sweeping overhaul of banking and Wall Street regulations aimed at ending the need for bailouts.
Because of this law, the American people will never again be asked to foot the bill for Wall Street's mistakes. There will be no more tax-funded bailouts, period.
The government will be given powers to break up companies that threaten the economy. It will shine more light on markets that escaped regulation and establishes a powerful council of regulators who'll keep a watch on the entire financial system. The laws also create a new agency to guard consumers in their financial transactions.
Someone's actually going to be reading the fine print for them. They're going to be making sure there's not teaser rates, there's not going to be inscrutable loan practices that we saw in the past. There's going to be credit cards that shouldn't be given to people to get people in financial trouble. So there's going to be a lot more protection for the consumer.
It makes G20 reform possible, and I think the good news for the world and for Australia is that the US legislation really moves in the directions that the world has wanted.
Although it didn't receive a ringing endorsement from the man who's on the government's Financial Sector Advisory Council, Macquarie Bank Chief Executive Officer Richard Shepherd.
We have regimes here in terms of the communication of information to the market through continuous disclosure, which I think is a world-leading regulatory approach. So I think that in general, yes, we should absolutely study the best practice overseas, but Australia has actually been ahead of the game in many of these areas over the past 10 to 20 years.
Investors are now hoping for some good news from the next big event, a report on the health of European banks due this weekend. The US equivalent a year ago helped shore up global confidence, and its impact will be a factor for Australia's Reserve Bank when it considers interest rates in less than 2 weeks.